Trust is the foundation of accounting. Think of it like glass. It's fragile and takes only seconds to shatter. When a CPA commits a discreditable act, it's not just their career at stake, it's the public's confidence in the work of accountants and auditors. Today, we'll explore the specific behaviors under Rule 501 that can break this trust and why they matter. Rule 501 lists 10 discreditable acts that can tarnish the image of the accounting profession and erode public confidence. The mnemonic, "My dishonest neighbor forgot coffee for dark, very fine scones," might help you remember the behaviors that are considered a discredit to CPAs and the profession. Let's look at each one of these behaviors. Misrepresentation includes providing false information, engaging in misleading practices, or making unsubstantiated claims which can damage the profession's credibility. For example, imagine CPA Jones is working for a company and is responsible for preparing its financial statements. Under pressure from the company's management to present a more favorable financial picture to shareholders and investors, Jones intentionally manipulates the financial data to make the company's financial results appear stronger. Jones changes key financial figures such as revenue, expenses, and profits and creates a false impression of the company's financial performance. That's misrepresentation, and it violates the principles of integrity and accuracy that are fundamental to the accounting profession. The CPA's actions not only compromise their own professional ethics, but also undermine the credibility of financial reporting. Misrepresentation is not limited to financial data alone, though. False, misleading, or deceptive advertising, for instance, guaranteeing audit results, exaggerating experience, or making unsubstantiated claims also fall in this category of misrepresentation. Dishonesty might seem like misrepresentation, but it's different. Dishonesty includes participation in fraudulent activities, deceptive practices, or unethical behavior such as theft or embezzlement. Honesty and integrity are foundational principles in the accounting profession. That makes sense, right? People want to trust accountants and auditors because they rely on their services and their audit opinions. Here's an example. A CPA is managing client funds in a trust account. Instead of keeping the funds separate, they quietly transfer $50,000 into their own personal account to pay off personal debts. That's dishonesty because it's outright theft and fraudulent use of client money. It's not about how the numbers are presented, it's about a deliberate act of fraud. Negligence is when the CPA is not exercising due professional care when completing accounting and auditing tasks, resulting in errors or misstatements in financial information, which could potentially harm the interests of stakeholders. For instance, a CPA is auditing a medium-sized manufacturing company and fails to adequately review and verify the company's inventory records. That is why the CPA doesn't see that there is a significant discrepancy between physical inventory and the recorded inventory in the financial statements. And of course, that's a problem that should have been identified and now has resulted in a misstatement. Next is the failure to follow professional standards, which includes ignoring or violating established accounting standards, laws, and regulations, which can undermine the reliability and consistency of financial reporting, eroding the profession's credibility. For instance, a CPA is hired to prepare a financial statement for a small manufacturing company. Instead of following generally accepted accounting principles, the CPA decides to use creative methods to make the company's balance sheet look stronger. That is considered a failure to follow professional standards. If a CPA doesn't file their own tax return without cause, it would also be considered a discreditable act in this category. The category of conflict of interest includes failing to disclose or appropriately manage conflicts of interest, which can compromise objectivity and independence, critical aspects of maintaining professional credibility. An example might be a situation where a CPA is assigned to audit a company where the CEO is a close friend of the CPA. Despite knowing the importance of maintaining independence and objectivity, the CPA fails to disclose the personal relationship to the relevant parties and proceeds to conduct the audit. The CPA's failure to disclose the personal relationship with the audited company and its decision to continue with the audit represents a failure to follow professional standards regarding independence and objectivity in auditing. Failure to cooperate with investigations includes refusing to cooperate with regulatory bodies or failing to respond to inquiries during investigations, which can be seen as an attempt to conceal unethical behavior and negatively impact the profession's standing. An example of a failure to cooperate with an investigation might be when a CPA is employed by a financial institution that is being investigated by regulatory authorities for potential financial misconduct. The CPA possesses important information that might be relevant to the investigation, but does not provide the information to the authorities conducting the investigation despite being aware of its importance. This constitutes a failure to cooperate with an investigation. Next, let's talk about discriminatory or harassment behavior. Any discriminatory or harassing conduct is a terrible look for any CPA and also reflects poorly on the accounting profession. Promoting a culture of respect, diversity, and inclusion helps prevent such behavior and upholds ethical standards within the profession. Violation of confidentiality includes situations where the CPA breaches client confidentiality or discloses sensitive information without proper authorization, like, for instance, when a CPA discloses client financial data to a competitor without authorization. Violating client confidentiality can lead to severe consequences for both the client and the CPA involved. Failure to disclose material information includes omitting relevant information or not disclosing material facts and financial statements, which can in turn mislead stakeholders and damage the profession's credibility. For example, a CPA is responsible for preparing financial statements for a manufacturing company. The CPA becomes aware of a significant pending legal dispute that could potentially result in substantial financial liabilities for the company. However, the CPA intentionally omits this information from the financial statements. This omission distorts the financial statements and presents an inaccurate picture of the company's financial health. Substance abuse includes engaging in substance abuse or addiction that impairs professional competence and can have detrimental effects on the quality of work and the profession's reputation. CPAs are expected to perform their duties with the highest level of competence and ethical conduct, which becomes compromised by substance abuse. In addition, driving drunk could result in DUI convictions, which are reported to the State Board of Accounting. The board will evaluate the factors, but the DUI may result in the loss of the CPA license. To summarize, CPAs have ethical responsibilities that include the CPA's duty to uphold the profession's image and trust, and the AICPA Code emphasizes that discreditable acts harm both CPAs and stakeholder trust. CPAs should also adhere to the AICPA Code, stay updated on ethics and laws, and seek guidance during ethical dilemmas to maintain professional standards. Upholding values of honesty, integrity, objectivity, and transparency is crucial in preventing discreditable acts and protecting the accounting reputation. Maintaining high ethical conduct not only safeguards CPA's reputation, but also ensures clients, investors, and the public have faith in the accounting profession.